Julian, emerging markets have suffered a bit of late due to the strong US dollar. Do you think this is going to continue, or do you think that there are various parts of the market that are still doing well anyway?
I think in the short term there is a bit of pressure, as you said, because of the dollar. The long-term outlook for emerging markets is very good. It's only really a question of timing when they're going to be bottom. If you're worried about the short-term timing, then obviously you should probably hold off a little bit. But otherwise, I think it's a very good entry point to be getting into emerging markets. You've got a group of countries which represent over half the world's economy, growing at 5% plus per annum. You've got compound earnings growth of double digits, low teens at the moment, and you've got a price earnings ratio of 11 times, which is an unusually attractive entry point for the asset class. So I think unless you're very optimistic on the dollar, in other words, you think the dollar's going to go a lot stronger, and I think the best part of the dollar rise is probably past us, then I think it's probably a good time to be getting into emerging markets.
And how is the dividend culture changing in emerging markets?
It's evolved quite a lot over the last 10 years or so. So if you look over the last decade, you'd have almost trebled your money in emerging markets. And of that return, an increasing component of that has come from dividends. So specifically over the last 10 years, about a quarter of your return investing in emerging markets has come from dividends. And what effectively has happened is that as companies have become more mature, as the growth rate has slowed from the sort of 7-8% growth to the closer to 5% growth levels you're at the moment, companies are needing to invest less to fund their future growth, and instead are choosing to pay back an increasing proportion of that back to shareholders in terms of dividends. So in other words, these companies are looking a little bit more like the growth companies in the West. So what you have in emerging markets is a group of companies that are still growing at a reasonable rate, because if you think about it, you've got 5% economic growth, you've probably got 2 or 3% inflation, so you've got in nominal terms you've got roughly 8% growth. And then you've got a bit of operational leverage from the company, so you've got low teens earnings growth or mid-teens earnings growth. So these are still reasonably healthily growing businesses, but nonetheless they're paying they're both continuing to invest in the future of the business, but they're also increasingly paying money back to shareholders. So if you take Samsung Electronics, which is one of the biggest and certainly the most famous emerging market company for Western investors, their dividend has increased every year for the last 6 years. So they're paying 110 won for dividends in 2011. Last year they paid over 1,500 won, so they almost over 10 times as much dividends to shareholders. So, and that's probably an extreme example, but nonetheless, it's a sign that the dividend culture in emerging markets has evolved fairly rapidly over the last decade.
And in which companies or sectors or countries are you finding the best opportunities at the moment?
We're seeing opportunities across the emerging world at the moment, actually. Obviously, Asia is becoming more and more important. The Asian economies are growing at a faster rate than those of Latin America, Eastern Europe, Middle East, Africa, and so on. So Asia is probably 3/4 of our opportunity set is in Asia. Notably, of course, China and India. These are the two giants in the emerging world. Both of them are rapidly growing economies. China is growing at over 6% per annum. India, which is, of course, a poorer country, therefore coming from a lower per capita income basis, is growing at an even higher rate. So certainly those would be two areas that we look at in particular. Within the terms of sectors, in terms of the opportunity set, we believe if you've got these economies that are growing at 5+% per annum, you want to be closer to the consumer. You want to be closer to the types of things that the average person in China, in India, in Brazil, in Mexico, in wherever it is in Eastern Europe, where they're going to be spending their money. But also you need to be looking at companies which can benefit from that with high and sustainable profit margins. So we like things like airports, for example, as people travel. We like things like insurance companies. We like things like some of the technology businesses, for example. So there's a whole raft of sort of broadly speaking, consumer-facing, domestic demand-facing businesses where we find the best opportunities.
And when it comes to trade wars and what's going on in the US at the moment, will that have a significant impact on emerging markets, do you think? Or as you're investing in more domestically facing businesses, do you think actually the impact will be less than people may expect? I
think what's going on with trade policy from Washington is one of the reasons why the US dollar is so strong, and it's effectively accentuating what was an existing trend. In the short term, this means that fewer people are wanting to buy emerging markets. In the longer term, of course, it means that these economies are actually more competitive than they were because their currencies are somewhat cheaper. But certainly it accentuates, I think, the move towards domestic demand. It means that these economies, and they are trading a lot more with themselves. So if you go back 15 years or so, trade between emerging economies accounted for only about 25% of world trade. Trade between emerging markets now is accounting for about 40% of world trade, and that percentage is going to grow over time. So the US, of course, is still very important, and these trade wars, I think, as much as anything else, because you haven't had a situation like this for probably 70 or 80 years in economic history, they are a big question mark. But I think that it almost reinforces our view that you want to be closer to the domestic consumer and find out really what's going on in these domestic economies, rather than having a portfolio which is focused on businesses that may lose out from what's going on the trade side.
Thank you very much.
Pleasure.